What's up, traders? My name is Austin Silver. You're going to love what you see in today's video. But if you are not trading Forex and you're looking to maybe transition from Forex into futures, like I did about a year ago, I've got two new courses for you that are newer, beefier, more valuable, and are going to make you more profitable. So if you want to check those out, there's a link in the description. Join us on ASFX TV. You get access to our live streams every day, our Discord, and of course, the two new courses, Futures 101 and Futures 2.0. Thank you very much for checking out this video. Enjoy the Forex course, and hopefully we'll see you on ASFX TV very soon. Welcome to chapter number 4. In this chapter, we're going to break down the D2 entry signal. Now, this is very similar to the D1 signal, so before we go forward, I need to make sure that you've finished in its entirety chapter 3. And if you have any questions about identifying divergence, identifying a D1, how to draw divergence, even basic questions, please reach out to me before you go forward. I want to make sure that before we go into the D2, you really have a good handle on how to identify the D1 trades, how you identify the 3 jabs to divergence, how you identify the trend on the higher time frames, and then how you work your way down through that checklist. That all needs to be under your belt before we go forward here. Now, I have to warn you, these D2 trades are less probable than the D1 trades, but as with every course that I've ever made, as basically with every lesson that I've ever taught, I like to make sure we're looking at both sides of the coin. So while the D1 trades are our in-trend high probability trades, these D2 trades are not as probable, but still present really, really unbelievable risk reward opportunities sometimes that we want to be able to identify. That way we can make the decision ourselves if we want to take advantage of it. For example, as I'm filming this, we're watching a D2 idea on the 1-hour chart on GBP NZD developing now over the last 3 days. We've been watching this trade and we called it 3 days ago. So with some of these moves, on the D2 and just like on the D1, you're going to be able to ride them out for multiple days. And that's why it's important to be able to identify counter trend, D2, and in trend, D1. Now, the reason these are less probable is because you're basically taking a D2, you're basically trying to call the bottom or top, and that's always going to be tough. It's important to keep in mind the direction of the higher time frames because that is always going to dictate overall trend. And it's important with these D2 ideas to also know when to walk away. There's going to be a few examples that I show you here in this chapter where very clearly, if you stayed and tried to jab at it, you could have easily taken 5, 6, 7 trades, all losses. So you have to be careful and have to understand how to use the higher time frames to make sure that you're not trying to buy something at the bottom when it's clearly falling on every other time frame. And in the same token as knowing when to pull away, you need to know when to step on the gas. Meaning if you can find something that has clearly shown you support at a level and higher time frames tell you this could reverse, then looking for this D2 signal I'm about to show you would make sense at that point. So it goes hand in hand. Now, the thing about reversals and the thing about calling the top, catching the knife, and all that fun stuff that we're going to talk about is that it can be appealing. But you have to remember that the market does not have to do anything. There's no such thing as too overbought or too high, and there's no such thing as too oversold or too low. The market can do whatever it wants, and you have to keep that in mind because there's always a first for everything, right? Now, in an uptrend, where you're going to look for the D2 ideas is off the top. Now, I wanted to put this in text for you so you could understand as price is moving higher, making higher lows and higher highs. We would look if we can see divergence building on top to then identify it as a D2 entry or not. In the same token, in a downtrend, if price is making lower lows and lower highs, we would look to see if the D2 would present at the bottom, showing us on the RSI that it's oversold and looking to see if it's going to start rising. As the RSI would pull higher, the price would drop lower, and that would create the divergence that can build a D2. You want to make sure that you're not getting caught holding the bag. What I mean by that is when I show you these examples, you're going to see very often we're trading EMA to EMA, especially on the higher time frames, the 15-minute, the 1-hour, the 4-hour. In that situation, if you're up over 2R in any of these trades, you don't want to give any money back. I would be very disappointed to hear anybody here taking a D2 trade being up 2R, which means you're risking 10 and you're up 20, and then getting stopped and taking a loss on that trade. Now, something else that I can't stress enough is the willingness to accept loss is going to make or break your D2 entries. And like I said last slide, you have to know when to walk away. So meaning, remember we talked in last chapter about if you take 2 D1 trades and they don't work out, then you would look to just find another trade something else, send me the markup, and we see what we can do. You're looking at something wrong, we need to fix it, right? The same thing applies here. If you try to call a bottom on GBP NZD and you lose twice, pull away. You might be right. It might rise by the end of the day. You might have had a great idea, but your timing is off, and I don't think there's an excuse ever to take more than 2 losses on one pair. Something is wrong. You're reading it wrong, or maybe it's just the most irregular day of the entire currency trading market's history, right? Either way, you have to know, hey, I'm going to take my 2 losses here and I'm going to move on. Even if it moves without me, I'm going to move on. I need to do better analysis. There's something wrong here. One thing that I have to continue to drive home to you guys is that for the most probable trades, you're going to want to use the D1 entries in trend always. You're going to then use this D2 signal to hopefully help you stay out of bad D1 trades, and then at the same time, turn around and possibly present you high probability risk reward setups when you use the higher time frames to confirm that D2 reversal idea. Now, the entry signal is very similar to the D1. We're looking for the divergence to be start, set, and confirmed. There's 3 hits at least for the highest probability divergence, and we're then looking for the break of the 50 EMA for the entry signal. The stop is exactly the same as the D1 as well. It's going to go to pin high or pin low of the divergence structure on the time frame that you entered on. Now, for trade management, I would never risk more than 1% on a D2 entry. For most of the setups that I take, I risk just about 0.5% or less. Again, we're trading counter trend. It's always going to be, I would say, like a second place trade to the D1, because the D1 is those in-trend, high probability movers. Now, that doesn't mean that there's not great D2 ideas. And again, that's why this chapter exists, because there's still highly profitable risk-reward opportunities if you can understand how to define and read a D2. Now, when we trade the D2 using the 2R take profit idea, you also want to keep in mind the levels using EMAs. So if you're trading EMA to EMA, meaning you're trading underneath the 50 and the 200 and the 800, so the 50 is above you first, when you get to that 50 EMA, that can be a significant level where if the higher time frame trend is, for example, like this example, it's short, you would possibly see it hold that 50 EMA and then move against you because you're buying it off the bottom. That would be a situation where you would want to make sure you're using EMAs as levels of take profit. So when you measure your setup on a D2 idea, you want to always, just like the D1, look for that 2R at least. Now, if there's an EMA in the way of you getting 2R, take that into consideration when you consider taking the position. The EMAs are significant levels, and if you're trading against the higher time frame trend, you might be able to get some money to the first EMA, the 50, maybe even to the second EMA, the 200, but it's very rare that if the higher time frames are against the direction you're trading, that you're going to see that full reset to the 800 EMA. Now, I know I just gave you a lot of information here on this slide, but we're going to go into the charts and you're going to understand a lot of what I just said in a second. I want you to remember this as well. You're going to look for the D2 off a key level, which means we're buying it off the bottom or selling it off the top, right? We talked about the uptrend versus downtrend already. You can also find the D2 ideas at overbought or oversold or ADR max, reversal points. Think about it. Those are key levels that can be used to see the market turn. The break of the 50 EMA is still the entry signal. That is the signal that the bias is changing. So if you're seeing price rise and it becomes divergent on top and the RSI starts to fall, right? That's where you would then potentially look to see if you could find a D2 to take it lower. You would then want to go to the higher time frames to confirm or deny that short direction. If it can be confirmed, you then go to the 1 minute, just like you do with the D1, and try to find the best possible entry. So this is basically the D1 entry just flipped upside down. So here, this is a really good first example because I want to emphasize the fact that it's very difficult sometimes to call a bottom and you have to look for these trades off key levels. So here, it hits oversold, which is a key level. However, there's no price shelf. You can clearly see price moving down, liquid 50s in the sell zone, EMAs are coming into a downtrend. Clearly, EuroCAD is short biased here. However, if you're looking at the 1 minute, look at this divergence building. It's also oversold on the 1 minute. It's rising on the RSI and it's falling on price action. So you would then say to me, Austin, it breaks the 50 EMA, we would go long there, right? I would refer back to the 15-minute chart and say, where's the bias here? Clearly, it's short. So especially knowing, again, for this example, the higher time frames are short biased, this is a poor idea to take a long position in because there's so many things that are telling us this is coming lower. The EMAs here, the L50 here, the higher time frames we know from the previous day are moving down as well. The only key level that you could justify this as being bought off of is oversold. And to me, because there's no price here, yesterday's low is not here, this is not a key level to be buying it off of. That's why this 1 minute divergence doesn't work. Now, it's important to reference what we talked about last chapter too. Once you took this trade, it does become divergent on top. It moves into profit slightly, about 9 pips at most, 8 pips, and then it becomes divergent on top, which would tell you it's changing and to get out of the trade potentially. So it's actually something that you could maybe make a little bit of money off of, but off the jump from the 15 minute, as you can see here, it ends up falling way lower as the day goes on because the higher time frames are short biased. That L50 started the day in the sell zone, and that's where you were looking to buy it right here, and it just fell away way lower than you were trying to trade it. So it's important to keep in mind here, guys. For this example, again, you're like, Austin, why did you just show me a losing trade as the first example of the D2? It's important to keep in mind that calling the bottom or trying to call the top is going to be difficult, especially when you don't have key level that you're trading off of and higher time frames in your direction. So let's take a look at Euro USD on the 15-minute chart. Now, a lot of these examples I'm going to show you are going to be on the 15-minute and the 1 minute, but this methodology, just like the D1, applies to any time frame. But for this example, we're looking at an EMA L50, really nice combination going long. The liquid 50s in the buy zone, EMAs are in an uptrend. So clearly a long bias pair. That's why this short idea that I'm showing you here in a second is a D2, because we're looking to sell it here off the top. That idea comes from the falling RSI as price action is rising. So when price pumped higher here at 7:30 in the morning, 7 o'clock in the morning, whatever it is, and the RSI did not, that signals to us that there's something going on. Something is going to change. When it breaks the 50 EMA, you could look to take a potential entry signal short on the D2 idea with the stop at the high, trying to trade this to the 800 EMA. Now, the risk reward here is not great. It's not even a full 1R to the 800 EMA. You're looking for it to go to the 800 EMA on the time frame that you took your entry, because that would be full reset. Now, you would then look to the higher time frames to see if you could look to hold the trade through that 800 EMA, because they're, for this example, short biased as well, and then they would say we could hold the trade for multiple days. Now, this develops very nicely, as you can see, down to the 800. The first thing that I'm going to point out here on this example, and I'm going to emphasize it a lot as we go through, is look at what the liquid 50 does here, just like we like to see on a D1 trade. It moves into the zone that we want to trade, which is short. So it moves into the sell zone before the RSI can cross back up through it. That's exactly what we look for on the D1. So these are basically the same trade ideas, the D1 and D2, but flipped upside down. Now here on the hour chart, you see Euro USD is actually in the buy zone on the TDI. EMAs are coming into an uptrend. But here, at the point of entry, price had just broken under the 8 and the 21 EMA. That's when we were looking to take the possible short position. On the 4-hour chart, L50 was in the sell zone, had just pulled into the buy zone the previous day, but EMAs overall were in a downtrend, so you could figure here that there's a short idea as well. On top here, you should be able to notice divergence. See how from this RSI high set to this price action high, you have a falling RSI line and a rising price action line? That tells you that something is going to change from this rise. Something is changing here, which would tell us potentially it's coming short. You follow me there? Notice it's on the 1 hour as well. RSI high set here at 12 o'clock. Look here, as price action jabs higher, 2 days later, 3 days later, that creates a rising line on price action, a falling line on the RSI, and that would lead you to feed into a short idea as well. So now you're using divergence on all time frames, you're using the L50 on all time frames, and the EMAs on all time frames to determine the trend. Yes, the L50 is in the buy zone here, but there's divergence on top. On the 4-hour, it just broke into the buy zone, and overall, it's in the downtrend. So on the 4-hour, you have divergence and more of a downtrend than not. So 4-hour, you could say is short biased. The hour here, you could say is short biased with the divergence on top. That would make it okay to potentially take a short idea here on the 15-minute chart. And that's why you're able to trade this down to the 800 on the 1 minute. Now let's move into another example here. It's going to start to click for you as we move through. This is NZD CAD. So on the 15-minute, I'm going to show you what it looked like at the time that I was watching it for the potential D2 idea. So I see the divergence on the bottom, 3 hits very clearly coming into the from yesterday into today into the Asian session. It breaks the 50 EMA right here, right before 6 a.m. And that tells me that we could look to trade up towards the 800 and the 200 up here. That sets it up for pretty good risk reward, just about 2R. Now, on the 4-hour, this is where you were located when you were looking to go long. Outside the 8 EMA, under the 50, looking like it's headed down towards the 200 and the 800. More importantly than that, or just as important, I should say, is the divergence on top telling us this is coming lower. 1, 2, 3, 1, 2, 3. You can see that very clearly. So being divergent on top on the 4-hour, we want to make sure we also check the 1-hour to see the position of the TDI and the EMAs to see if that is short or long biased. And here you can see L50 has been in the sell zone for about 2.5 days. Price action's been dropping for about 3.5 days. So clearly it's not long biased either. And that's why from that breakout on the 15-minute right here that I just showed you, this is what happened the rest of the day. It chopped around and would stop you out. So it's important that if you're going to try to call the bottom, you don't try to buy something when the 4-hour is floating out here off the 8 EMA and it's divergent on top telling you it's coming down. That doesn't make any sense. You have to use these higher time frames and get them in your favor if you're going to click the button. If they're not in your favor, you're not doing proper top-down analysis, and then if you take a loss, I can't feel that bad for you. Look at the hour chart here. The L50's in the sell zone, so you can clearly see why this is very hard to go long into. 4-hour and 1-hour, both divergent on top, 1-hour L50 in the sell zone, 15-minute L50 in the sell zone here as well. Trying to reverse this off the bottom, it's just very, very tough. So when we get into the good examples here in a few minutes, I want you to just keep this in mind. The key levels that you use off the higher time frames and from basically the 15-minute, the 1-hour, and the 4-hour, those key levels are going to carry through and really prove to be what determines successful trades versus unsuccessful trades. Here, my favorite pair, GBP NZD. So we were looking potentially to go long here. Now, there's divergence from the previous day very clearly. The RSI looks like it's slowly rising as price action is falling. This is heavily short biased on the higher time frames. Look at the EMA starting to come down into a downtrend, right? Today, clear downtrend. If you were looking at this for A1 breakouts, this L50 and EMAs clearly are telling you to short this thing today. So it breaks the support zone that it was set at yesterday's low, and it looks like it's headed back to retest it. Now, if you were looking to go long in here, already I'm hoping that you're putting together that this is kind of foolish because it's clearly in a downtrend. So trying to buy it here is very silly. But there is divergence there and a break of the 50. 1, 2, 3 hits, 1, 2, 3, you see that, and then it breaks the divergence. This ends up rising EMA to EMA, right to the 200, and then pulls right back down to your entry on the 1 minute. So this is 1 minute, breaks the 50, up to the 1 minute 200, can't really hold that, and ends up coming back down to your entry and then stopping you out. Now, look at where you tried to buy it on the 15-minute. You're floating outside the 8 EMA with a perfect L50, perfect EMA combination telling you that it's short biased. And that's why it ends up moving lower here today and stopping you out. So again, you're not buying it off a key level. You're buying it off a breakout, basically. This would have been the key level. If it would have been consolidating here and rising off the bottom, then it would have made sense to try to buy it off the low that it pinned 2 or 3 times earlier in the day. But to try to buy it down here just because it's off the 8 EMA makes very little sense to me. Now, in this section, we're going to get into just 15-minute markups, meaning you find divergence on the 15-minute time frame and you enter and manage off the 15-minute time frame alone. Again, you can always take this to the lowest time frame possible, but sometimes the divergence stops at the 15-minute and you can't find anything at the 1 minute or the 5 minute. So you have to be able to spot these on the 15. Now, the first one we're going to talk about is EuroCAD. As you can see, the previous day here, let me turn my pointer on. The previous day here, at about 10, 11 o'clock in the morning, the RSI sets its low. Price action falls as the RSI rises into the next day, into the Asian session. It breaks the 50, which tells me that that could be the entry long going counter trend towards the 800 EMA. That is the ideal take profit, that full reset. But the emphasis for this markup is that, as you see in my notes, it doesn't have to go all the way to the 800 EMA. This makes it to the 200 and pulls back to your entry. It gives you another chance the next day at that same price level where it bounced off of during the first day you traded it, and then it ends up stopping you out if you don't take your profit. So you remember the slide where I said don't get caught holding the bag? This is a perfect example of it. Here, the higher time frames clearly were not long biased. That's why this doesn't go to the 800 EMA. So because I'm saying don't get caught holding the bag. What I mean by that is I don't want you to get caught getting stopped on this trade after it moves to the 200 twice for you. It goes EMA to EMA when you're trading counter trend. If you're in at the 50, next idea of take profit or where you think it could consolidate is the 200, then the 800 is your ideal take profit, which is normally over 2R as it is in this example. But here, again, my emphasis was it's divergent on the bottom, it breaks the 50, but it doesn't always have to go to that 800 EMA full reset. Now, another example, Euro NZD. So you see the divergence had oversold the previous day. You see that falling price action, rising RSI, sets the zone here at our low of day right before basically 12 o'clock. And I call that the low of day because that's where we consolidated at during the changeover of day and into the Asian session. So that's clearly the level, the significant level. On the 15-minute, as that RSI continues to rise, it actually breaks the 50 EMA as it comes back through that zone with a shift candle, right? We would call on the A1 system that 8 and 21 cross is a shift. So with that 50 EMA break, again, you're using the pin low as your stop, and you're looking to take it full reset or to 2R, full reset to the 800 or to 2R. This is 1.6R to full reset at that 800 EMA. And it goes there. So right there, this is another example of don't get caught holding the bag, because what does it end up doing as the day goes on? It falls back down in the direction of the higher time frame trend, which was short. But you're still able to come in and get a piece of this as it moves higher. If you remember back in last chapter, we actually went over a short idea here off the 800 as a D1. And that's important, and that's kind of a really good thing to bring up at the end of the course here as we get into the last few chapters, because this is how I want you to put the whole system together. It's trading D2 counter trend and then finding D1s in trend, trading the market as a wave. I don't believe in Elliott waves. I don't understand any of that stuff. I think it's almost too complicated for what we need to accomplish as retail traders. But for me, using this divergence makes a lot more sense to trade in the format of a wave, meaning a correction and impulse, things like that. So here, what we're looking at is the move down the previous day. It consolidates at that level. This divergence pullback is created to the significant level of the 800, and then it moves back down in direction of overall trend. For me, it's easy to spot because the divergence is set at the bottom, and then it breaks the 50 EMA. My stop was 22 pips on this idea, and it goes 35. So you're getting a nice trade out of this one, counter trend. Now, let's take a look at GBP JPY. Now, this is a divergence entry off the top, so it's D2 off the top as we were in an uptrend. So you see the huge 300 pip, 400 pip candle on the GBP news. That created divergence because the RSI went over 80. RSI naturally is going to have to fall at some point from that. Price action did jab a little higher. It broke the 50 EMA right before the New York session that day. Now, this was a Friday. It drops on Friday and then consolidates Monday into Tuesday. Really doesn't move much. But Tuesday, it ends up making its final move down to that 800 EMA. So just like I showed you on the 1 minute, where you break the 50 and you're looking for it to go to the 800, you can do the same thing here on the 15-minute time frame. So it breaks the 50. You're looking at your entry as a D2 idea. Stop is at the high of the divergence structure. This falls and holds the 50. Spends a day in consolidation under your entry, you're in profit. If you had moved your stop into profit, it would have got you. So you can't do that really on these trades. You need to trust them, at least until it breaks under the 200. Now, the following day, really this was Tuesday, this breaks the 200, retests, and then makes its way down through the 800. So the emphasis here being be patient with your trades. And with D2 ideas, you should not be in the trade thinking, I got to move my stop right away. These are ideas that sometimes, especially on the higher time frames, will take days, if not weeks, to run and hit that full take profit idea. I have a few examples at the end of this chapter on Euro USD. You'll see it's like 4 days long, but once you have that bottom, because of the higher time frames, it carries very, very well. Now, let's take a look at Euro AUD. This is at the changeover of day. Australian dollar is open here during the Asian session, so this would be something I think that is tradable for sure. Look at the divergence as the price action falls at the end of the day and the RSI is rising. off oversold. So that is a key level. It's yesterday's low, right? Because we're in the changeover of day here. So you're coming off of yesterday's low. You're coming off of oversold. You know that if it breaks the 50, it could get to the 200. And if it breaks the 200, it could get to the 800. And you have to be patient because look, it sits at your entry price for a while after moving into profit. But the idea is still, hey, the higher time frames tell me I should take this to the 800, and that's what I'm going to look for to do. I'm not going to close this trade early. I have a 35 pip stop. I'm looking for 75. I'm getting my 2R to the 800 EMA. And you get it in the same day. This entry is like 5:30, 6:30 at night, New York time, and by 9, 10 a.m. New York time, the next day, you've made your money, at least 2R. So here, the emphasis being oversold, off yesterday's low, 1, 2, 3 hits to divergence, and then your break of the 50, which is your entry signal, stop at the pin low, and it moves to the 800. So I'm hoping you're seeing the repeatable pattern here behind the D2. It's very, very similar to the D1, right? Break of the 50 after divergence is set. The only difference is now you're trading in the direction of EMAs and you're using them as significant levels that can either tell you to take profit or tell you that the risk reward isn't good enough to even take the trade. There are areas where the market is going to slow down and you can't forget that. So let's take a look at another example on Euro CAD. You see L50s in the buy zone all day. EMA is coming into an uptrend, but it builds divergence. So this is a situation where you would say, Austin, wouldn't we look in the 50 here to go long as a D1? No, remember, you have to check the 15-minute, and if there's divergence on the 15-minute, you would be hesitant to go long off the 50 here, right? To the point where maybe you do take a long, but it stops you out. As it breaks the 50 here, you can get in short because you understand that this is a D2, not a D1. Look at the divergence. 1, 2, 3. 1, 2, kind of a third. That third jab is much more qualified on the RSI, especially because it doesn't break the trend line. So then, yeah, maybe you're looking for longs in here as a D1 idea because of the perfect L50 and the EMAs, but it doesn't work out. Whether you get in or not, this breaks the 50 EMA with divergence on top, which sets your stop at the pin high of the divergence structure, 16.5 pips, and this falls through the 800, through the 200, 40 pips by the end of the day. Now, in a setup like this, because the 800 was so close, I wouldn't use that as the take profit idea. Your 200 EMA was underneath. The higher time frames were short biased, which is why this carries lower. So I would not pay so much attention to the 800 in a situation like this, just because it would really disqualify the trade completely. You would never just look to trade from the 50 here down to the 800 with a stop at the pin high. That just wouldn't make sense as far as risk reward. So you'd have to use the higher time frames to say, yeah, I'm trading it through the 800, through the 200. I'm looking for more than that. And that's where it goes. Notice here, the L50 gets right into the sell zone for you, just like we like to see with D1s. Once it breaks the 50, the next thing you want to see is L50 get into the zone that I'm trading. And since you're trading short here, that's why it jumps into the sell zone. Here, let's take a look at Euro JPY. So we have divergence building from the previous day, oversold. You see, we break under yesterday's low, but can't really hold. We're coming back towards yesterday's low when it presents the potential long signal. It breaks the 50 after having 3 hits to divergence. So your stop goes at the divergence structure low, and you're looking to trade it EMA to EMA. And here, it just doesn't make it. It only makes it to the 200 and it stops and comes right back down to your entry price. So if you take the trade and you're in at 120.26, it rides up to 120.41, you're still going to get almost 15 to 20 pips out of this trade. Now it's not great risk reward, but at least you're not losing if you're managing this appropriately, knowing that you don't want to get caught, what? Holding the bag, right? So as it comes to the 200, you see how price is rising and there's a doji in there? I guarantee you on the 1 minute it forms divergence. Divergence on the top here at that significant level, clearly in a downtrend overall, tells us that this rise might be ready to change. And that's exactly what happens. So as you get good at this, you're going to be able to use divergence to tell you when the market's changing in multiple directions, meaning you're going to be able to read it to the top, find divergence at the top, and then read it to the bottom. So it's important to be able to use the D1 and D2 hand in hand. You don't have to marry one or the other. I would always push you to trading more D1s than D2s, but still using the D2 to not miss easy money. Just like that previous example that I showed you where you could have been looking for longs, instead it breaks the 50, comes short as a D2. I've been in trades where I will be long. One of them was GBP CHF just a few months ago, and I was long with 2 positions, got stopped, took it back to the 15-minute time frame, saw that it was clearly divergent on top, the 1 hour was short biased, and I got right back in, flipped my direction short, and made money back and covered that earlier loss long. with no problem. And that's because I'm able to use the D2 and the D1 hand in hand. But I lean on the D1 always. Here, we're going to take a look at CAD CHF. So divergence, again, always building from that previous day. It's always good to see that because it shows strength, especially across the higher time frames. Now, EMAs are clearly short biased, L50s in the sell zone. So this is overall in a downtrend. Look at where it goes. From the break of the 50, your stop is at the divergence structure low, and it goes right to the 200, and then ends up forming a little bit of divergence as price is rising just slightly there, and the RSI is falling. Better than that, you can see the RSI went higher here. So from that point, with price rising, you see the RSI falling. It's divergent there as well. So to get in that trade, see it pump to this high, and once it hits that high, it doesn't make a new high on the RSI past the previous point here. So you know it's building divergence at that 200 EMA in an overall downtrend. That tells us that this rise could be ready to change and it could be ready to move back in overall trend. And that's what it does. If you would have held this trade trying to go to the 800 EMA up here, you would have lost. And that would have been very foolish. That would have been getting caught holding the bag. Here, you're in the trade off the break of the 50. It forms divergence once you're in. It's at a significant level and your counter trend. Take the money and move on. Do not be greedy. Again, I can't emphasize it enough. Do not get caught holding the bag trying to take every single one of these trades to the 800 EMA. You're going to regret it. So let's take a look at another example, another GBP pair. This is GBP JPY. From the previous day, RSI hits oversold and starts to rise. Price action twice jabs lower than the previous day's low, but can't hold underneath it. It closes one bar underneath it and comes right back up. Closes two bars under it and right back up. So with price coming slightly lower and the RSI rising, that's divergence. That's bullish divergence. It breaks the 50. The stop goes at the pin low, and it ends up ripping, as you can see, well through ADR. Now, my take profit would have been set at the 800 EMA at best, but from the jump, this is the same pattern over and over and over again. Divergence off a key level, break of the 50, traded counter trend to the 800 EMA, and this goes right through it. Here, another JPY example. This is CHF JPY. Off the top, look at this divergence building on the 15-minute. RSI sets its high here at 6 a.m., 5 a.m. the previous day, and just continues higher. Price just jabs and jabs and jabs. RSI does not, though. It falls. Once price breaks the 50, you're looking for an entry there to take it back to the 800, and that's exactly what happens. It's the same pattern, guys. Your stop goes at the pin high of the divergence structure, and once you're in the trade, you're watching the L50 on the time frame that you entered to get into the zone that you're trading. Here, you want it in the sell zone because you're trading short, and it goes right to that 800 EMA. Very little pain in this trade. It doesn't break back through any of the EMAs. It actually puts a body through the 200 here, retests the 200 nicely, and then holds the 8 EMA all the way down to the 800. So you get a nice trade right off the top. So when you see this rising price and this falling RSI, don't scroll past it. Don't ignore it, because you could still take this as a potential counter trend trade, especially when the higher time frames tell you that they're short biased as well. In a situation like this, if the 1 hour and the 4 hour and the daily are all short biased, then you know it's okay to potentially take this D2 idea. And if you got stopped, take the second one. And if you get stopped on the second one, send me the markup. We need to talk. Let's go through another CAD CHF example here. As you can see, RSI goes way overbought at like 9, 10 o'clock yesterday morning. Price continues higher even into the next day as the RSI falls. That third hit to divergence, that third jab as price goes higher. So here was reaction point 1, reaction point 2, and then the third jab here is reaction point 3. Now we're started, set, confirmed. Breaks the 50, stop at the pin high, and it falls through the 200 over 2R, about 30 pips from the entry. So with this, you don't need to take it all the way down to the 800 EMA. You can't even see that in this photo. You can get 2R on this setup, and it doesn't have to go that far. So to get 2R and then be able to lock the stop and see what the higher timeframes are telling you if you should manage accordingly, meaning hold the trade or not, that's totally acceptable. But just understand, if you go 2R on any trade, on any pair, if it's D2 and you're going up 2R, you better not be giving back money on that trade. I don't care if you made it to the 800 EMA or not. If you're up 2R, you cannot give back any money. Now, as we move into the next section of markups, I want to keep the focus on the higher time frames. So we're going to make sure that now that we've identified how to read a D2 just on the 15-minute, now we're going to focus on how to confirm that read with the higher time frames. So the first one we're going to look at is Euro GBP. Now, you remember we looked at GJ on the UK election news and it had a huge candle that pushed up. This is Euro GBP, so on that same day, it's going to move opposite. This is a huge candle that pushed down. And what did it do? Just like we saw, it created divergence for GJ on the top. This is showing divergence on that news on the bottom. So with the RSI hitting oversold, setting its low at the changeover of day, price jabbing a little lower about 2 or 3 hours later, but the RSI not coming lower, that sets the divergence here on the 15-minute. So after it breaks the 50 EMA, we're looking to see if this will come up to the 800, you see it above here, and we're looking at the liquid 50 to see if it'll get into the buy zone. Now, it does. It moves from the 50 to the 200, but we know that these don't have to go full reset, especially in that first day. So here, it pulls back overnight and actually would put you into a little bit of drawdown. The stop here, if you had taken an entry like this after the news and held over the weekend, because remember, this is Friday into Sunday, Monday right here, this is a 60 pip stop. So it would have pulled down into about a 30 pip drawdown for you before moving higher into the next day during the Asian session and hitting that 800 EMA. Notice, if we take a look, it actually continues higher even the next day. It goes 173 pips from that original 50 EMA break on the UK election news. Now, what I was looking at was the divergence here on Monday. Look, it hits oversold during the Asian session. It pushes out of the Asian range box right at the changeover into London, and price goes lower, but the RSI does not. So that creates divergence on the bottom. So we're now looking for a 50 EMA break to take this to the 800. Now, this is a much cleaner trade Monday into Tuesday. However, I wanted to show you that it actually started on Friday. So you have to remember always to check the previous day, because this divergence is really what carried this thing higher all week. Now, it's important to notice here, this is where you do get some divergence and get the re-entry on Monday, or for me, it was the first entry ID on Monday, and notice the liquid 50 gets right into the buy zone exactly like we like to see. This reaches the 200, retests the 50 and holds, breaks the 200 and holds overnight, and then makes its way up to the 800. And from that entry, with a 23 pip stop, so a much smaller stop, this goes 182 pips into the next day. This is Monday into Tuesday. A really nice trade here. I was in this trade, but I pulled it early, made a mistake. I definitely could have done better. I think that for me, the reason I got out early was because it was a Monday and I didn't want to start the week with a D2 loser. But it was a really good idea, and I think that idea could have even carried you into later in the week. So here, this is on Monday into Tuesday on the 16th. That was Monday. The 17th was Tuesday. Here on the 18th on Wednesday, look at how it chops sideways all day. But if you're still holding that long bias, this actually presents a D1 idea off the 50 EMA and retests high of day. Now, it is divergent on top, which we know signals that it could chop or drop today. It ends up chopping, right? The divergence on top signals change from the previous day's rise. The change being, again, chop or drop. Here, it chops, but because you're buying it off the low, you're able to trade it right back up to the Asian range high, the high of day, and there's 2R in this trade. Look at the divergence here. It's under the 50 EMA on the 15-minute. It's under the 1-minute 800, but it's 3 clear hits. 1, 2, 3, at least, maybe even 4 if you want to qualify that as your 4th test of this level. It breaks the 50 EMA right there. That's your entry. Stop at the pin low. It moves up briefly. As you can see right here, it moves up for a few minutes and then ends up pulling you back down. But in that pull down, look at the divergence that builds. The L50 then gets right back up into the buy zone, and this continues higher, up about 21 pips from that entry. So the entire thing here, I want to just recap this Euro GBP markup so you understand all of the points I want you to take from it. Number one, the divergence did not start on Monday. It's there on Monday, but it actually started the previous day here on Friday on the news. Seeing it present again here on Monday just confirms the idea that this level at 82.77 at the bottom from Friday, that is going to be held. So the divergence from Friday is good. Then you see divergence again here on Monday. It breaks the 50, and that would be your D2 entry signal. Now, it is oversold, but it's still a break of the 50 with divergence on bottom, holding the level from Friday. The L50 then gets up into the buy zone, price continues to rise, and this makes its way up to the ideal take profit level of the 800 EMA. For all the D2 ideas, I keep saying this, all the D2 ideas, you're looking to at least get to the 800 EMA. That's your ideal take profit level. Then you use the higher time frames to see if you should hold it and be able to take more off of this. Notice, if you Put your take profit at the 800 EMA and check this trade later in the day from when you took your entry, when I would have taken my entry at 2:45 in the morning. You could have moved a stop into profit and locked the trade at the end of the day and then just held it, and overnight it would have taken off for you. So it's important to keep the higher time frames in mind and use the bias to not just identify one entry. Keep that bias throughout the week, and Wednesday here, you're able to use that long bias from Monday to create an idea off the 50 EMA that still presents 2R, even trading within that range to the high of day with a falling liquid 50. But the L50 confirms the long bias. EMAs are long. This is a D1 here off the 50 following that D2 idea. So I want you to see the whole picture for what it is. You're using the D1 and the D2 together to call the Euro GBP rise, and then you're going to trade that rise throughout the entire week, like you see here on Wednesday potentially. Now, let's move into an example here on Euro CAD. So here we're looking at the hour chart first. Left to right, you see we're starting on the 5th. RSI sets its low. Price jabs lower 2 days later on the 7th, and then we see a break of the 50 EMA on the 8th at 9 a.m. So here, Euro CAD, we know the euro could pick up some volume as this heads into the New York session. So it's 9 a.m. You're thinking this thing could pick up some rise. If you look at the 4 hour, it's very indecisive. Price is falling over the long term. You can see the 800 EMA is on top, but recently RSI is rising, L50 broke into the buy zone, and price is actually making what looks like, at least for now, a higher low than the previous low set at the end of November. So maybe we're coming into a short-term uptrend is the thought here, but overall very indecisive on the 4 hour. So you can't trust it too much. It's not showing you one way or another. So what I would rely then to is to go to the lower time frame on the 1 hour and see again, where's the direction that this is telling you to trade. The L50 is rising and it breaks into the buy zone after this 50 EMA, which is exactly what you'd want to see after your entry. And it doesn't stop you out before rising basically about a week and a half later. Now you're in on the 8th. And by the 18th, you're up into profit pretty well. And then by the 20th, you're up over 140 pips. Now, what happens here, if you look at the 4 hour, is this carries to that 4 hour 800 EMA. The L50 rises, does not cross back down through the RSI, RSI does not cross back down through the liquid 50, and it rises into the buy zone. Once it breaks up to that 4 hour 800 EMA, it becomes divergent on top here. It breaks the 50 EMA and ends up falling back down exactly to where your long entry price was back on the 8th. So if you take the long on the 8th and you're patient through and you're looking for 2R, you're able to get it here. You're actually able to get 4R. If you take that long and you make that money long, if you're watching the 4 hour, you know that it could bounce off this 800 EMA because it has done that before, and that would tell us overall it's still in a downtrend. So then you could be looking for shorts on the hour chart here off that 4 hour 800 EMA, and that's exactly what I have marked up right here. So it becomes divergent at the 4 hour 800 on top. The D2 idea would be to take it as a counter trend reversal short on the break of the 50 here on the hour, and it falls 118 pips. So it's important to take note of how we're still starting on the higher time frames and always trying to back ourselves down as low as we can. But more importantly than that, with this markup, you should see you can trade divergence on the bottom as a D2 idea with indecisive higher time frame trend, to then seeing it retest a higher time frame key level and then trading a D2 down off that key level, short off the 800 EMA in the overall 4 hour downtrend here. So you're able to go up and down using divergence. Both of them basically D2 ideas. Neither of them would be a D1. This is D2 off the top here the next day, and this is D1 here back on the 8th. This is D2 as well back on the 8th because it's coming off the bottom in what, at least on the short-term 4 hour, looks like an uptrend here as you see price moving higher. Again, another markup here on GBP NZD. So this was a trade I was in while I was actually on vacation. This slowly made its way down, testing this zone that I had set the previous day. Once price reached this zone, you see the box going across here, that told me that we could see a bounce higher off of it. That was the idea. Now the L50, as you can see here, is clearly short biased. It's in the sell zone more than not today. So I'm going counter trend to what the L50 is telling me. EMAs are coming into a downtrend, so I'm going counter trend to what they're telling me. So that makes it a D2 idea. But I was able to take that 15-minute divergence that finally set in when price came lower, but the RSI did not here. This is 3 o'clock in the afternoon, New York time. Finally, that sets in. I was able to get down to the 1 minute, and again, off this zone, I was able to find more divergence. So you see me taking it to the lower time frame at this key level of support from the previous day. RSI is rising for about 45 minutes. breaks the 50 EMA here, stop at that pin low, and this thing rides, as you can see, into the next day, 67 pips. So yeah, it was a 20 pip stop, but it carries over 3R counter trend, which is a great trade. That's great risk reward to get 3R counter trend. So the 15-minute was not clearly long biased, but look at the EMAs with the 800 underneath, then the 200, then the 50. That tells me that the higher time frames, the 1 hour, the 4 hour, were more likely long biased than short biased. So to see that, even with the L50 in the sell zone, I was confident to say, look, higher timeframes are somewhat long biased. We're trading off a level that we bounced and could not break even last night. And we have divergence on the 15-minute, which tells me to check the 1 minute, which shows me divergence. And we have 2 hits here. So there was enough confirmation to make the risk reward worth this trade. And that's why I took it. I slept on it. I paid the overnight fee, and it ended up still being profitable, even though I had to pay that fee. So let's take a look at NZD-JPY, another example here. We have divergence on top on the 15-minute. It's a D2 idea because the L50 and EMAs are both long biased. So on the break of the 50, you have a potential D2 entry signal here. You're looking then for the L50 to get into the sell zone before the RSI crosses back up through it. That is exactly what happens. From the entry, your stop is going to go at the pin high of the divergence structure, which is about 13 pips here. Notice how this breaks the 50, tries to get back above 3 separate times and cannot. That shows the price you're entering on is the significant level. When it breaks under, tries to retest again here and cannot break for another higher high and higher low, you know that you're probably in a good trade. Then you're waiting to see if this will break through the 200 and head down towards the 800. What ends up happening is as it breaks the 200, it becomes oversold here and divergent on the bottom. So then you would use this divergence on the 15-minute bottom to tell you what? That a change is coming. A change of this drop is coming. How do you know what to do? Whether to hold the trade or close? You go to the higher time frames. So on the hour, you can see the L50 and EMAs clearly are long bias. Price today has broken under the 50, but overall, this is clearly in an uptrend. On the 4 hour, same thing. L50 clearly long biased. We just broke the 21 EMA, but overall, you can see on the 4 hour, it's very, very long biased. So to be short here on the 15-minute and to be up over 2R, you can see it goes 2.7R. And to see this divergence telling you that something is going to change, I would use this to take the full 2.7R, 2R, whatever it is, from your entry, wherever you happen to close the trade, and I would be more than happy with that as a winner. Why? Because the higher time frames were not fully short biased. The idea is definitely there. And of course, you're always going to see it turn on the shorter time frames before you see it turn on the higher time frames. But trying to catch that turn all the time and catch the full move and be right saying you called the real top, the top of the year, the bottom of the year, it's very, very difficult. So it's much easier, as I've been saying, to consistently be able to get in and hit that 2R. And then if the higher time frames call for it, let's say the L50 and EMAs were short biased here, then we would look to lock the stop and hold the trade. Another example on EuroCAD here. This one's a choppy trade, but it's important to identify how it's trading off the key level of the low of day. So you see low of day was set here at about 2:45 in the morning with 2 pins. It bounces off that low and retests it at about 5 in the morning. Notice price action falling and the RSI rising. So that creates 15-minute divergence, which tells us that we could potentially look for a D2 reversal going long to the 15-minute 800 EMA. So then we take it down to the 1 minute, and as you can see, we have 3 hits. Divergence started, set, and confirmed as price comes lower 3 times, and the RSI does not. So then the break of the 50 is your entry signal, stop at the pin low, and this goes from 145.87 to 145.98. Now again, look at the 15-minute. This makes it through the 50 to the 200, cannot break the 200 and ends up falling back down and would stop you out if you held the trade. But look at the L50 here today. It's falling from the previous day, falling down into reset, if not into the sell zone as the day goes on. EMAs are short biased. So overall, this is clearly a short biased pair. So to try to get caught, or to try to grab the whole bag, I should say, you're going to get caught holding the bag if you don't take profit here at that 200 EMA. Notice again that if you're paying attention, this trade being under the 15-minute 50 EMA, being off the low of day, that is the idea that this is coming off a significant level. But again, like I said, if you're paying attention, these EMAs and L50 are clearly short biased. So you shouldn't be trying to milk this trade all day. Another example, another Euro example, this is Euro USD. So here, I've actually mentioned this earlier in the course. This is one of those multi-day runners. This runs for 3 days, 104 pips with a 14 pip stop. Notice the divergence on bottom. You see RSI said it's low. Price jabs a little bit lower the next day. This is October 1st, and then it breaks the 50 EMA right here. Your stop goes at the pin low, and you're looking for this to rise to that 15-minute 800 EMA. Now, I almost just said to you right here, 1-minute 800 EMA. And normally I'd edit that part out, but I want you to hear me saying this little mistake of almost calling this chart the 1 minute when we're looking at the 15-minute. That's because this whole system is fractal. If I'm looking at the 1 minute for entry, I'm looking for it to go to the 1-minute 800. If I'm looking at the 15-minute for entry, I'm looking for it to go to the 15-minute 800. That's the D2 idea. Now, of course, it might go a lot further than that 1-minute 800 on the D2 reversal ideas if you're just trading on the 1 minute, which is why I always recommend you use the higher time frames to tell you whether to hold the trade or not. Because if it breaks to the 1-minute 800 EMA, right, which would be the 15-minute 50, then you should know to then look at the 15-minute and see where the bias is there. And if it's in the direction that you're trading, you could feel confident to say, look, this is a short time frame. I'm going to hold this and let it go to the 15-minute 800 EMA and see if you can rock it off the higher time frames to actually be able to make your trade instead of just from the 50 here to the 200, from the 50 here all the way through the 800 for the 80 pips, or maybe even for the full 100 pips into the end of the week here. But it starts with being able to identify the divergence on the bottom and then manage it EMA to EMA. Notice the break at the 200, the retest of the 200. It's very, very clear. So we're going to reference now to another example on GBP/NZD. As you can see, price moved lower overnight off the 800 EMA. EMA is coming into a full downtrend, L50 falling into the sell zone. But the previous day, as you can see, we caught some rise. This move is almost off of yesterday's low. It's basically at the same level that it consolidated at the 50 EMA. So we see this pullback to the significant level that we consolidated at yesterday. So when we're pulling back, right, and we know that the higher time frames are long biased because of the previous day's move, you can go to the 1 minute and identify divergence here. It's oversold 345. You see price falls, RSI rises, and it breaks the 50 and takes back off to the 800 EMA here on the 1 minute. So as I just mentioned in the previous slide, you're looking at that 1 minute 800 as the first take profit level because you're entering here on the 1 minute. But then you're going to go to the 15 minute and say, wait a minute, that's only right here. If we're bodying through there, we could make it to the 800 EMA here. So maybe I should hold this trade, especially because, like I said, the higher time frames are long biased. So that gives you more confidence to not just close the trade at the 1 minute 800 EMA right here, especially because look at how that liquid 50 rips up into the buy zone. It does not cross back down in the sell zone exactly how we like to see. And that's how you know you're in a good trade. That L50 gets right into the zone that you're trading. So here you're buying it. So you want the L50 into the buy zone. Again, off that low of day here, set a few, like 45 minutes before, and it's really more off the previous day's consolidation level. So it's D2 because it's counter trend. L50's in the sell zone, it's swapping, EMAs are in a downtrend. So if anything, you would be short biased on this pair had you not understood how to identify D2 ideas. Looking back and seeing the consolidation the previous day, looking at the shorter time frame and seeing the divergence here on the 1 minute. Another example, this time on NZD CAD. So here, overall, you can see we are short biased. EMA is coming down, price moving lower from the previous day, and L50's in the sell zone. It becomes divergent on top, which signals to us that change could happen if a 50 EMA is broken. Here you can see RSI low is set the previous day, price jabs lower here, and then it breaks the 50 EMA at about 4 o'clock in the morning. That break could signal a change of bias to the 800 EMA. However, with choppy EMAs like this, the 800 EMA is very close, and it does go to the 800 EMA, but then ends up pulling back down, and it chops basically the rest of the day. This is a day of reset. If you look at it from the start of the day to the end of the day, it's very choppy, and that's because the L50 is rising towards that stationary 50 and swapping. That's what creates the chop. But I want to emphasize the divergence on bottom. Sorry for the voice crack. The divergence on bottom telling us that this could be potentially rising to the 800 EMA. Once it makes it to the 800, the EMAs are not in trend, so it's not a clean trade. But where's your bias? Based on the EMAs, based on the L50, based on price action, it's short. Divergence on the bottom is there, but the L50 is in the sell zone, EMAs are coming down, and price moved lower yesterday. So if you go to the 1 minute at that 15-minute 800 EMA right here, the 1 minute looked like this. Divergence clearly building. A break of the 50 EMA here ends up getting you stopped out. Now, if you stayed focused, you're able to watch, see divergence being built and not broken, and you're able to get back in here on the second break of the 50 EMA. So you were in here, you get stopped because the RSI moved back through the L50 in the buy zone here. Remember, we want to see that L50 get down into the zone that we're trading. Notice how once you take this 50 EMA break, the L50 gets right into the sell zone and it drops down to the 1 minute 800 EMA here. Now, the risk reward start to finish is not ideal here. The EMAs are in no trend. L50 is coming into reset. It's almost trading within the Asian range. It had just broken out recently. So there's not a key level that's very identifiable to trade to. You're trading off a lot of significant levels because you're in chop. You're probably in a significant level on the daily or the 4-hour time frame. But the short bias is there even with the divergence on the bottom, and that's why I was able to identify this as a risk-reward opportunity, following the same pattern, following this D2 idea. Divergence off the key level. First one stops you out. You take that loss. You're in at 83.97. You're out at 84.01, so 4 or 5 pips at most. And then you're back in here, and you're able to get in at 84 flat and ride that thing down to 83.89. So for 11 pips, you're able to cover that loss and still end profitable, even on a really crappy looking trade like this one. For the last markup of this chapter, of course, it's going to be GBP/NZD. This is off the ADR max idea and the yesterday's high idea. Now remember, I said those were key levels that you could look to trade off of. You see GBP/NZD catches a massive move here that ends up maxing out ADR at 152, 151.8, whatever you want to call it. That's how many pips it moved today. And now, since we were at that ADR max level, I looked back and saw we were also at yesterday's high. So to trade this back down towards the 800 EMA is the D2 idea. L50 is in the sell zone more than the buy zone, but it's swapping. It's all over the place. This thing is oversold. So you're trading off the key levels in the direction that the L50 is telling you, but more in the idea that this is going to come back and reset itself after the rip and maxing out ADR, because you don't think it's going to. Again, you're trading with the idea that it's not going to be an above average day and break out for new highs. You're trading with the idea that, okay, it maxed out ADR, it can trade back down here without moving ADR because it already made that move. So this doesn't cost any more money for them to move price if that's how you want to look at it. So again, it's at ADR max, it's at yesterday's high. You take it to the 1 minute. It's super overbought here on the 1 minute. Price becomes divergent. It breaks the 50 EMA for the first time here. Doesn't move much. And actually becomes divergent on the bottom here around 9 o'clock and ends up coming higher. It doesn't go to that pin high. It respects that pin high. That's this pullback right here. It was just testing yesterday's high one more time, and then it ends up moving lower for you down to the 800 EMA. So you're in at 2.0232, and you're riding it to 2.0168. So a nice trade here, about 2R with the pin high as your stop. So the same pattern applies here that we've used to every other markup throughout the entire chapter. I want to summarize the D2 trades for you now so we can really make sure that you understand. These are always going to be less probable trades. I've said that probably 75 times, and that means that they should be traded with appropriate size. Now, in the next chapter, we're going to go over risk management, entry signals, exit signals. The whole thing is going to get summarized. But keep in mind, these D2 trades, in my opinion, should never get more than 1%. The best D2 trade for me will get a 1%, and that's very, very rare because catching the falling knife can be very, very tricky. And these are trades that you are trying to catch the falling knife. You're selling it off the top like I just showed you or buying it off the bottom. Now, if the higher time frames agree with the direction that you're trading, that trade is going to be a lot more probable and you might be able to catch that falling knife. But a lot of the markups that I showed you, you're finding D2s in indecisive higher time frame trend. And if you do that, that could lead to a choppier trade and a less probable setup. So use the D2 very wisely. I'm giving you a lot of responsibility and a lot of firepower with this signal. That means you should not be taking it every time it presents. You should be using the parameters and being very picky with the D2 trades that you choose to put money into. You should still be looking to trade in the direction of higher time frame trend, but I would look to use the D2 at reversal points on the lower time frame. So if the daily, the 4 hour, and 1 hour are short biased, the 15 minute could be in the buy zone, but if it's at a key level, I might look to sell it as a D2 in direction of the 1 hour, the 4 hour, and the daily chart, like I just said. So that's our D2. If you have any questions, please drop a comment down below. Please make sure that you reach out to me if you have any if you need clarification on anything at all. And as always, send me your markups of the D2 ideas that you see so I can critique and adjust you as needed. So now that we've moved through the D1, now that we moved through the D2, you should really feel confident in understanding what these entry and exit signals are and how much risk you should be using on each trade that you take. In the final chapter, we're going to review everything one more time, so join me in Chapter 5.